110. The objective of the disclosure requirements is for an entity to disclose sufficient information to enable users of financial statements to understand the nature, amount, timing and uncertainty of revenue and cash flows arising from contracts with customers. To achieve that objective, an entity shall disclose qualitative and quantitative information about all of the following. A. Its contracts with customers, see paragraphs 113 to 122. B. The significant judgments and changes in the judgments made in applying this standard to those contracts, see paragraphs 123 to 126. And C. Any assets recognized from the costs to obtain or fulfill a contract with a customer in accordance with paragraph 91 or 95, see paragraphs 127 to 128. 111. An entity shall consider the level of detail necessary to satisfy the disclosure objective and how much emphasis to place on each of the various requirements. An entity shall aggregate or disaggregate disclosures so that useful information is not obscured by either the inclusion of a large amount of insignificant detail or the aggregation of items that have substantially different characteristics. 112. An entity need not disclose information in accordance with this standard if it has provided the information in accordance with another standard. Contracts with customers. 113. An entity shall disclose all of the following amounts for the reporting period unless those amounts are presented separately in the Statement of Comprehensive Income in accordance with other standards. A. Revenue recognized from contracts with customers, which the entity shall disclose separately from its other sources of revenue, and B. Any impairment losses recognized in accordance with SLFRS 9 on any receivables or contract assets arising from an entity's contracts with customers, which the entity shall disclose separately from impairment losses from other contracts. Disaggregation of revenue. 114. An entity shall disaggregate revenue recognized from contracts with customers into categories that depict how the nature, amount, timing and uncertainty of revenue and cash flows are affected by economic factors. An entity shall apply the guidance in paragraphs B87, B89 when selecting the categories to use to disaggregate revenue. 115. In addition, an entity shall disclose sufficient information to enable users of financial statements to understand the relationship between the disclosure of disaggregated revenue, in accordance with paragraph 114, and revenue information that is disclosed for each reportable segment, if the entity applies SLFRS 8 operating segments. Contract balances. 116. An entity shall disclose all of the following. A. The opening and closing balances of receivables, contract assets and contract liabilities from contracts with customers, if not otherwise separately presented or disclosed. B. Revenue recognized in the reporting period that was included in the contract liability balance at the beginning of the period, and C. Revenue recognized in the reporting period from performance obligations satisfied, or partially satisfied, in previous periods, for example, changes in transaction price. 117. An entity shall explain how the timing of satisfaction of its performance obligations, see paragraph 119a, relates to the typical timing of payment, see paragraph 119b, and the effect that those factors have on the contract asset and the contract liability balances. The explanation provided may use qualitative information. 118. An entity shall provide an explanation of the significant changes in the contract asset and the contract liability balances during the reporting period. The explanation shall include qualitative and quantitative information. Examples of changes in the entity's balances of contract assets and contract liabilities include any of the following. A. Changes due to business combinations. B. Cumulative catch-up adjustments to revenue that affect the corresponding contract asset or contract liability, including adjustments arising from a change in the measure of progress, a change in an estimate of the transaction price, including any changes in the assessment of whether an estimate of variable consideration is constrained, or a contract modification. C. Impairment of a contract asset. D. A change in the time frame for a right to consideration to become unconditional, i.e. for a contract asset to be reclassified to a receivable. And E. A change in the time frame for a performance obligation to be satisfied, i.e. for the recognition of revenue arising from a contract liability. Performance obligations. 119. An entity shall disclose information about its performance obligations and contracts with customers, including a description of all of the following. A. When the entity typically satisfies its performance obligations, for example, upon shipment, upon delivery as services are rendered or upon completion of service, including when performance obligations are satisfied in a bill and hold arrangement. B. The significant payment terms, for example, when payment is typically due, whether the contract has a significant financing component, whether the consideration amount is variable, and whether the estimate of variable consideration is typically constrained in accordance with paragraphs 56 to 58. C. The nature of the goods or services that the entity has promised to transfer, highlighting any performance obligations to arrange for another party to transfer goods or services, i.e. if the entity is acting as an agent. D. Obligations for returns, refunds and other similar obligations, and E. Types of warranties and related obligations. Transaction price allocated to the remaining performance obligations. 120 An entity shall disclose the following information about its remaining performance obligations. A. The aggregate amount of the transaction price allocated to the performance obligations that are unsatisfied, or partially unsatisfied, as of the end of the reporting period, and B. An explanation of when the entity expects to recognize as revenue the amount disclosed in accordance with paragraph 120A, which the entity shall disclose in either of the following ways. I. On a quantitative basis using the time bands that would be most appropriate for the duration of the remaining performance obligations, or 2. By using qualitative information. 121 As a practical expedient, an entity need not disclose the information in paragraph 120 for a performance obligation if either of the following conditions is met. A. The performance obligation is part of a contract that has an original expected duration of 1 year or less, or B. The entity recognizes revenue from the satisfaction of the performance obligation in accordance with paragraph B16. 122 An entity shall explain qualitatively whether it is applying the practical expedient in paragraph 121 and whether any consideration from contracts with customers is not included in the transaction price and therefore, not included in the information disclosed in accordance with paragraph 120. For example, an estimate of the transaction price would not include any estimated amounts of variable consideration that are constrained, see paragraphs 56 to 58. Significant judgments in the application of this standard. 123 An entity shall disclose the judgments and changes in the judgments made in applying this standard that significantly affect the determination of the amount and timing of revenue from contracts with customers. In particular, an entity shall explain the judgments and changes in the judgments used in determining both of the following. A. The timing of satisfaction of performance obligations, see paragraphs 124 to 125, and B. The transaction price and the amounts allocated to performance obligations, see paragraph 126. Determining the timing of satisfaction of performance obligations. 124 For performance obligations that an entity satisfies over time, an entity shall disclose both of the following. A. The methods used to recognize revenue, for example, a description of the output methods or input methods used and how those methods are applied. And B. An explanation of why the methods used provide a faithful depiction of the transfer of goods or services. 125 For performance obligations satisfied at a point in time, an entity shall disclose the significant judgments made in evaluating when a customer obtains control of promised goods or services. Determining the transaction price and the amounts allocated to performance obligations. 126 An entity shall disclose information about the methods, inputs and assumptions used for all of the following. A. Determining the transaction price, which includes but is not limited to estimating variable consideration, adjusting the consideration for the effects of the time value of money and measuring non-cash consideration. B. Assessing whether an estimate of variable consideration is constrained. C. Allocating the transaction price, including estimating standalone selling prices of promised goods or services and allocating discounts and variable consideration to a specific part of the contract, if applicable. And D. Measuring obligations for returns, refunds and other similar obligations. Assets recognized from the costs to obtain or fulfill a contract with a customer. 127 An entity shall describe both of the following. A. The judgments made in determining the amount of the costs incurred to obtain or fulfill a contract with a customer, in accordance with paragraph 91 or 95. And B. The method it uses to determine the amortization for each reporting period. 128 An entity shall disclose all of the following. A. The closing balances of assets recognized from the costs incurred to obtain or fulfill a contract with a customer, in accordance with paragraph 91 or 95, by main category of asset, for example, costs to obtain contracts with customers, pre-contract costs and setup costs. And B. The amount of amortization and any impairment losses recognized in the reporting period. Practical expedients. 129 If an entity elects to use the practical expedient in either paragraph 63, about the existence of a significant financing component, or paragraph 94, about the incremental costs of obtaining a contract, the entity shall disclose that fact. Appendix A. Defined terms. This appendix is an integral part of the standard. Contract, an agreement between two or more parties that creates enforceable rights and obligations. Contract asset, an entity's right to consideration in exchange for goods or services that the entity has transferred to a customer when that right is conditioned on something other than the passage of time, for example, the entity's future performance. Contract liability, an entity's obligation to transfer goods or services to a customer for which the entity has received consideration, or the amount is due, from the customer. Customer, a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. Income, increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in an increase in equity, other than those relating to contributions from equity participants. Performance obligation, a promise in a contract with a customer to transfer to the customer either a good or service or a bundle of goods or services that is distinct, or b. a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. Revenue, income arising in the course of an entity's ordinary activities. Standalone selling price of a good or service. The price at which an entity would sell a promised good or service separately to a customer. Transaction price for a contract with a customer. The amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties. Appendix B. Application guidance. This appendix is an integral part of the standard. It describes the application of paragraphs 1 to 129 and has the same authority as the other parts of the standard. B1 This application guidance is organized into the following categories. A. Performance obligations satisfied over time, paragraphs B2, B13. B. Methods for measuring progress towards complete satisfaction of a performance obligation, paragraphs B14, B19. C. Sale with a right of return, paragraphs B20, B27. D. Warranties, paragraphs B28, B33. E. Principal versus agent considerations, paragraphs B34, B38. F. Customer options for additional goods or services, paragraphs B39, B43. G. Customers' unexercised rights, paragraphs B44, B47. H. Non-refundable upfront fees and some related costs, paragraphs B48, B51. I. Licensing, paragraphs B52, B63b. J. Repurchase agreements, paragraphs B64, B76. K. Consignment arrangements, paragraphs B77, B78. L. Bill and hold arrangements, paragraphs B79, B82. M. Customer acceptance, paragraphs B83, B86. And N. Disclosure of disaggregated revenue, paragraphs B87, B89. Performance obligations satisfied over time. B2 In accordance with paragraph 35, a performance obligation is satisfied over time if one of the following criteria is met. A. The customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. See paragraphs B3, B4. B. The entity's performance creates or enhances an asset, for example, work in progress, that the customer controls as the asset is created or enhanced. See paragraph B5. Or C. The entity's performance does not create an asset with an alternative use to the entity. See paragraphs B6, B8. And the entity has an enforceable right to payment for performance completed to date. See paragraphs B9, B13. Simultaneous receipt and consumption of the benefits of the entity's performance, paragraph 35a. B3 For some types of performance obligations, the assessment of whether a customer receives the benefits of an entity's performance as the entity performs and simultaneously consumes those benefits as they are received will be straightforward. Examples include routine or recurring services, such as a cleaning service, in which the receipt and simultaneous consumption by the customer of the benefits of the entity's performance can be readily identified. B4 For other types of performance obligations, An entity may not be able to readily identify whether a customer simultaneously receives and consumes the benefits from the entity's performance as the entity performs. In those circumstances, a performance obligation is satisfied over time if an entity determines that another entity would not need to substantially reperform the work that the entity has completed to date if that other entity were to fulfill the remaining performance obligation to the customer. In determining whether another entity would not need to substantially reperform the work the entity has completed to date, an entity shall make both of the following assumptions. A. Disregard potential contractual restrictions or practical limitations that otherwise would prevent the entity from transferring the remaining performance obligation to another entity, and B. Presume that another entity fulfilling the remainder of the performance obligation would not have the benefit of any asset that is presently controlled by the entity and that would remain controlled by the entity if the performance obligation were to transfer to another entity. Customer controls the asset as it is created or enhanced, paragraph 35b. B5 In determining whether a customer controls an asset as it is created or enhanced in accordance with paragraph 35b, an entity shall apply the requirements for control in paragraphs 31 to 34 and 38. The asset that is being created or enhanced, for example a work-in-progress asset, could be either tangible or intangible. Entity's performance does not create an asset with an alternative use, paragraph 35c. B6 In assessing whether an asset has an alternative use to an entity in accordance with paragraph 36, an entity shall consider the effects of contractual restrictions and practical limitations on the entity's ability to readily direct that asset for another use, such as selling it to a different customer. The possibility of the contract with the customer being terminated is not a relevant consideration in assessing whether the entity would be able to readily direct the asset for another use. B7 A contractual restriction on an entity's ability to direct an asset for another use must be substantive for the asset not to have an alternative use to the entity. A contractual restriction is substantive if a customer could enforce its rights to the promised asset if the entity sought to direct the asset for another use. In contrast, a contractual restriction is not substantive if, for example, an asset is largely interchangeable with other assets that the entity could transfer to another customer without breaching the contract and without incurring significant costs that otherwise would not have been incurred in relation to that contract. B8 A practical limitation on an entity's ability to direct an asset for another use exists if an entity would incur significant economic losses to direct the asset for another use. A significant economic loss could arise because the entity either would incur significant costs to rework the asset or would only be able to sell the asset at a significant loss. For example, an entity may be practically limited from redirecting assets that either have design specifications that are unique to a customer or are located in remote areas. Right to payment for performance completed to date, paragraph 35c. B9 In accordance with paragraph 37, an entity has a right to payment for performance completed to date if the entity would be entitled to an amount that at least compensates the entity for its performance completed to date in the event that the customer or another party terminates the contract for reasons other than the entity's failure to perform as promised. An amount that would compensate an entity for performance completed to date would be an amount that approximates the selling price of the goods or services transferred to date, for example, recovery of the costs incurred by an entity in satisfying the performance obligation plus a reasonable profit margin, rather than compensation for only the entity's potential loss of profit if the contract were to be terminated. Compensation for a reasonable profit margin need not equal the profit margin expected if the contract was fulfilled as promised, but an entity should be entitled to compensation for either of the following amounts. A proportion of the expected profit margin in the contract that reasonably reflects the extent of the entity's performance under the contract before termination by the customer or another party. Or B. A reasonable return on the entity's cost of capital for similar contracts, or the entity's typical operating margin for similar contracts, if the contract-specific margin is higher than the return the entity usually generates from similar contracts. B10 An entity's right to payment for performance completed to date need not be a present unconditional right to payment. In many cases, an entity will have an unconditional right to payment only at an agreed-upon milestone or upon complete satisfaction of the performance obligation. In assessing whether it has a right to payment for performance completed to date, an entity shall consider whether it would have an enforceable right to demand or retain payment for performance completed to date if the contract were to be terminated before completion for reasons other than the entity's failure to perform as promised. B11 In some contracts, a customer may have a right to terminate the contract only at specified times during the life of the contract, or the customer might not have any right to terminate the contract. If a customer acts to terminate a contract without having the right to terminate the contract at that time, including when a customer fails to perform its obligations as promised, the contract, or other laws, might entitle the entity to continue to transfer to the customer the goods or services promised in the contract and require the customer to pay the consideration promised in exchange for those goods or services. In those circumstances, an entity has a right to payment for performance completed to date because the entity has a right to continue to perform its obligations in accordance with the contract and to require the customer to perform its obligations, which include paying the promised consideration. B12 In assessing the existence and enforceability of a right to payment for performance completed to date, an entity shall consider the contractual terms as well as any legislation or legal precedent that could supplement or override those contractual terms. This would include an assessment of whether a legislation, administrative practice or legal precedent confers upon the entity a right to payment for performance to date even though that right is not specified in the contract with the customer. B. Relevant legal precedent indicates that similar rights to payment for performance completed to date in similar contracts have no binding legal effect. Or C. An entity's customary business practices of choosing not to enforce a right to payment has resulted in the right being rendered unenforceable in that legal environment. However, notwithstanding that an entity may choose to waive its right to payment in similar contracts, an entity would continue to have a right to payment to date if, in the contract with the customer, its right to payment for performance to date remains enforceable. B13 The payment schedule specified in a contract does not necessarily indicate whether an entity has an enforceable right to payment for performance completed to date. Although the payment schedule in a contract specifies the timing and amount of consideration that is payable by a customer, the payment schedule might not necessarily provide evidence of the entity's right to payment for performance completed to date. This is because, for example, the contract could specify that the consideration received from the customer is refundable for reasons other than the entity failing to perform as promised in the contract. Methods for measuring progress towards complete satisfaction of a performance obligation. B14 Methods that can be used to measure an entity's progress towards complete satisfaction of a performance obligation satisfied over time in accordance with paragraphs 35 to 37 include the following. A. Output methods, see paragraphs B15, B17, and B. Input methods, see paragraphs B18, B19. Output methods. B15 Output methods recognize revenue on the basis of direct measurements of the value to the customer of the goods or services transferred to date relative to the remaining goods or services promised under the contract. Output methods include methods such as surveys of performance completed to date, appraisals of results achieved, milestones reached, time elapsed and units produced or units delivered. When an entity evaluates whether to apply an output method to measure its progress, the entity shall consider whether the output selected would faithfully depict the entity's performance towards complete satisfaction of the performance obligation. An output method would not provide a faithful depiction of the entity's performance if the output selected would fail to measure some of the goods or services for which control has transferred to the customer. For example, output methods based on units produced or units delivered would not faithfully depict an entity's performance in satisfying a performance obligation if, at the end of the reporting period, the entity's performance has produced work in progress or finished goods controlled by the customer that are not included in the measurement of the output. B16 As a practical expedient, if an entity has a right to consideration from a customer in an amount that corresponds directly with the value to the customer of the entity's performance completed to date, for example, a service contract in which an entity bills a fixed amount for each hour of service provided, the entity may recognize revenue in the amount to which the entity has a right to invoice. B17 The disadvantages of output methods are that the outputs used to measure progress may not be directly observable and the information required to apply them may not be available to an entity without undue cost. Therefore, an input method may be necessary. Input methods. B18 Input methods recognize revenue on the basis of the entity's efforts or inputs to the satisfaction of a performance obligation, for example, resources consumed, labor hours expended, costs incurred, time elapsed or machine hours used, relative to the total expected inputs to the satisfaction of that performance obligation. If the entity's efforts or inputs are expended evenly throughout the performance period, it may be appropriate for the entity to recognize revenue on a straight-line basis. B19A shortcoming of input methods is that there may not be a direct relationship between an entity's inputs and the transfer of control of goods or services to a customer. Therefore, an entity shall exclude from an input method the effects of any inputs that, in accordance with the objective of measuring progress in paragraph 39, do not depict the entity's performance in transferring control of goods or services to the customer. For instance, when using a cost-based input method, an adjustment to the measure of progress may be required in the following circumstances. A. When a cost incurred does not contribute to an entity's progress in satisfying the performance obligation. For example, an entity would not recognize revenue on the basis of costs incurred that are attributable to significant inefficiencies in the entity's performance that were not reflected in the price of the contract. For example, the costs of unexpected amounts of wasted materials, labor or other resources that were incurred to satisfy the performance obligation. B. When a cost incurred is not proportionate to the entity's progress in satisfying the performance obligation. In those circumstances, the best depiction of the entity's performance may be to adjust the input method to recognize revenue only to the extent of that cost incurred. For example, a faithful depiction of an entity's performance might be to recognize revenue at an amount equal to the cost of a good used to satisfy a performance obligation if the entity expects at contract inception that all of the following conditions would be met. I. The good is not distinct. 2. The customer is expected to obtain control of the good significantly before receiving services related to the good. 3. The cost of the transferred good is significant relative to the total expected costs to completely satisfy the performance obligation. And 4. The entity procures the good from a third party and is not significantly involved in designing and manufacturing the good, but the entity is acting as a principal in accordance with paragraphs B34, B38. Sale with a right of return. B20 In some contracts, an entity transfers control of a product to a customer and also grants the customer the right to return the product for various reasons, such as dissatisfaction with the product, and receive any combination of the following. A. A full or partial refund of any consideration paid. B. A credit that can be applied against amounts owed or that will be owed to the entity. And C. Another product in exchange. B21 To account for the transfer of products with a right of return, and for some services that are provided subject to a refund, an entity shall recognize all of the following. A. Revenue for the transferred products in the amount of consideration to which the entity expects to be entitled. Therefore, revenue would not be recognized for the products expected to be returned. B. A refund liability, and C. An asset and corresponding adjustment to cost of sales, for its right to recover products from customers on settling the refund liability.